Let's go to the next mail merge template. Let's set up a pro forma. That's a fancy word for a summary of the private investment repositioning. Select No on the requester. And now we select the spreadsheet. Word wants to know where is the mail merge data. It's right there on mail merge valuation. Word pulls in the data, and now we select preview mail merge results. And all the fields are filled in. Again, we delete the carrying costs because there are no carrying costs on this project. The direct repositioning costs and the finance charge can be deleted. We're not borrowing the money separately, so there's no finance charge. Now this template has fields for a first position financing and a second position financing. We've chosen to use only first position financing, so I want to delete all of the second position financing because those values are irrelevant. So there are no net proceeds for secondary tranche. Delete that. Come down here to the second tranche. Delete that. And because there's only one tranche, we don't need the combined values, the first and second combined. Now we show escrow debt reserves for 3 months. And under this repositioning structure, the debt coverage ratio will be 1.4722 with a cap rate of 17.7 and a healthy gross return on equity. The cash flow to the common equity investors is $44,052, which is $3,671 per month. Now the pro forma for the after repositioning valuation has been calculated by the spreadsheet. We plug in the pro forma values for income and expenses. The spreadsheet calculates the ARV, subtracts 30% retained equity. Therefore, the refinanced debt present value, the DPV, is $1,272,748. That's 70% of the ARV. We subtract 3% of that for closing costs, leaving the debt gross proceeds. We then subtract the repositioning future value to arrive at the debt net cash out proceeds. This is the number that will be split among the equity ownership. And here are the terms presumed for the refinance. 6% per year, 300 months, with an annual constant of 7.73 and a debt yield of 15.46. This is a very safe refinance structure. And after refinancing, we will have a debt coverage ratio of 2.0 with 50% of the net operating income going to the debt, 50% going to the cash flow on the property. The apparent capitalization rate will be 10.82%. The apparent gross return on retained equity, the 30% equity margin, will be 18% per year. This is also called the cash-on-cash yield. However, understand that the common equity investors have been completely paid off with a profit. They have no net cash invested, and therefore the return on retained equity is actually infinite. And then the pro forma cash flows before taxes on an annual and monthly basis. The break-even rate is the economic occupancy rate. If the occupancy rate falls to this number, there will be no net cash flow to the investors. If it falls below this number, there will be a negative cash flow on this property. This is a very safe number. Now, since we're not using preferred equity, we also delete these two paragraphs because they talk about preferred equity, and there is no preferred equity in this financing structure. Now here is the membership summary for the limited liability company. The common equity investors will pool together 3 months of debt reserves plus the 10% investment to value plus the 4% investment to value for the syndication premium. The total funds, almost $150,000. We then show how the ownership is split into membership units. Total number of units, 20. Subtract out the 40% ownership for the syndicator, leaving 12 units available for sale. That's 60% ownership. And thus the per unit price will be $12,479. We're showing monthly and annual cash flows per unit. And the annual yield, this would be the cash-on-cash yield, based on the total investment. They're getting 17.65% return on that investment during the repositioning project. Then we refinance the property, and the cash out total, $387,202. Subtract the 40% to the syndicator, leaving 60% for the common equity investors. That represents a per unit cash out of $19,360. That's a 155% returned to the common equity investors in 1 year. And they still own the property. They still have a positive cash flow now per unit of $4,900 with an apparent cash-on-cash return of 10.82%, but actually it's infinite because they have no money invested in the property. The cash out is tax-free if it is rolled into another investment property. It is a loan, and therefore it is tax-free. If you spend it on something else, then there will be capital gains tax to pay when the property is sold. So the best course of action is to continue to accumulate positive cash flow assets with no cash invested. Just roll this money into the next property, fix it up, refinance it, and roll it again. And then the remainder of the document is simply to cover the bases on this group investment. This is actually a syndication deal requiring accredited investors. So let's save this template as a PDF file. And now we close out.